U.S. stocks have dropped sharply after new concerns over Germany's Deutsche Bank.
Investors continue to worry about the health of the global banking system.
Banking is a nightmare. They can cause a lot of carnage when things go wrong.
What's up, everyone? This is Dale Anderson. I hope you're well. So I just wanted to update you on the latest banking crisis. So the banking system is getting a lot worse. Just 2 weeks after the collapse of several major banks, there's now rumored to be another on the chopping blocks. Except in this case, it's one of the biggest banks in the world. Deutsche Bank holds 3 times more money than Credit Suisse at $1.6 trillion. They also listed systematically important financial institution that is too big to fail. So just like Credit Suisse, they have been involved in a lot of controversy, leading some investors to believe that they could be next. That is why it's important we discuss exactly what's going on, why the banking crisis doesn't seem to be getting any better despite continuous rescue efforts, and what you can actually do about it to save money. Please subscribe for my free newsletter and guides. Obviously, we can give you a lot more information there. So let's talk about Deutsche Bank. For those who are not aware, this is more than a 150-year-old multi-generation German bank with offices globally, 82,000 employees, billions of dollars in income. In fact, they are one of the largest banks in existence. So this is where things start to get slightly different and take a bit of a different turn. On the surface, all of this stems from the banking crisis, which I will do my best to explain in under a minute. Throughout 2020 and 2021, interest rates were held at 0% to help incentivize the entire economy. This allowed people to continue to spend, borrow at very low interest rates, so cheap credit. As you would expect, a lot of that money flowed back into the banking system, which would be a reasonable move for people to make. However, when a bank takes your deposit, they don't just let it sit idle in a vault. Instead, they lend and invest it with the expectation of growing that money and giving some of it back to you as a reward for keeping it in the bank. In this case, though the banks had so much money and interest rates were so low, a large chunk of the deposits went into purchasing low-yielding US treasuries and government bonds, which plummeted in value once the Fed started to increase interest rates rapidly. In a normal market, this would not be a big deal since technically the bank still has access to the money, but Silicon Valley Bank was the exception, and when customers started withdrawing their money at the exact same time, that obviously caused a liquidity crisis, which eventually resulted in 3 banks collapsing. So what does that have to do with Deutsche Bank, you might ask? Shortly after the brief US banking panic, the international Credit Suisse bank started experiencing similar issues, with customers withdrawing billions of dollars from the bank, contributing to the bank's biggest annual loss since the financial crisis of 2008. The bank then admitted that they'd found material weaknesses in their financial reporting over the past 2 years because of ineffective internal controls. And when one of the biggest banks starts saying stuff like this, people begin to panic, causing them to continue to fall and make huge losses until USB stepped in to buy them for pennies to the dollar. What people found the most remarkable, just prior to Credit Suisse receiving a clean bill of health from regulators less than a week prior to completely collapsing, leaving everyone to wonder who is next. Apparently people think it would be Deutsche Bank, and it's easy to see why. For example, in 2007, they were fined $7.2 billion for misleading investors in its sale of residential mortgages-backed securities. In 2009, they admitted to engaging in covert espionage on its critics in management and the board members of the company, directed by its corporate security department. Furthermore, in 2015, they were forced to pay $2.5 billion for rigging interest rates, and from there they faced a variety of legal battles, from tax evasion, sanction violations, and money laundering. By 2016, the bank had been involved in 7,800 legal disputes and calculated $5.4 billion as litigation reserves. And that doesn't even count the Epstein fine of $150 million, or the 2018 money laundering scandal, the bribery fine in 2021 where they spooked precious metal futures, or the most recent strip club scandal where the employees tried to claim their nights out on business expenses. They also failed the Federal Reserve stress test in 2018 with concerns including material weaknesses in the firm's data capabilities and control supporting its capital planning process, as well as weaknesses in its approach and assumptions used to forecast revenues and losses under stress. Now, of course, practically every bank of that size is going to be subject to controversy, lawsuits, and fines. This is inevitable, but in this case, their share prices have taken a similar hit to that of Credit Suisse, having fallen 92% from its high in 2007 after a series of poorly timed investments and buyouts. And now their major concern over the bank's future and if they will make it through. In terms of what's happening today, look no further than credit default swaps. We explained this before, but basically anytime a bank issues a loan, they have an option of purchasing what's called a credit default swap, which acts like a kind of insurance in the event that the bank or the borrower doesn't pay them back. In this case, one bank is able to transfer the risk to another bank for a small fee, and the second bank takes on the risk. In the case the second bank has to pay the first bank, they're not completely out of luck because they assume the rights of the underlying investment and they would be collecting enough of a premium from other default swaps to cover the risk, right? So think of this like the insurance you pay to cover the losses if the bank was to go under, and the price of that insurance is dictated by the likelihood that investors think the bank is likely to go under. In this case, when it comes to Deutsche Bank, their credit default swap spiked in a similar fashion as Credit Suisse just before they were bought out, signaling that investors believe there's a high likelihood that potentially something could happen. Or simply put, people are drawing in a lot of comparisons between what happened to Credit Suisse and what is going now on at Deutsche Bank, and that is causing growing concern with investors and people start to panic. But is that actually the case? On the one hand, there's an element of banking failure that is simply because by people believing there's going to be a problem, there does become a problem. Like even if the bank is perfectly fine, all it takes is a percentage of their customers to begin withdrawing their savings at the same time, and before you know it, they're looking at the Federal Reserve to bail them out. Typically, this is worsened by other systematic issues like falling bond prices, a depleting in deposits, and slowing revenue. But at the end of the day, I believe belief in the company goes a long way. And sometimes that fear can self-perpetuate into a real problem very quickly. Now, in this case, analysts are saying that no, Deutsche Bank is not the next one to fail. As they explained, this bank now operates way more efficiently after massive restructuring. Their net income was up 159% in the last year, and the German chancellor said there was no reason to worry. A finance professor also recently said that the bank was a natural candidate for market sell-offs because of its previous troubles, complex holdings, and market skepticism about its future profits. So what we're seeing right now is simply panic and lack of trust in the markets that is driven completely by emotion. Personally, the way I see it, Deutsche Bank seems to be in a strong position. If anything were to get too bad, they would get bailed out just like every other bank before them. However, I also wouldn't discount panicked emotions turning into a very serious concern, because ultimately that could lead to a lot happening, especially when it comes to investor confidence. And in terms of what this is meant, in terms of what this means to you, your money, and the markets, here's what you need to know. My initial thoughts is that this sounds overblown, even though investors are justified to have concerns due to the sudden collapse of other banks, which has also sounded a bit overblown. In terms of the average person in the UK and the US, it's probably nothing major to worry about, especially if you're not holding millions of cash in the bank or putting all your life saving into bank stocks. Surely something could happen, but nothing surprises me these days. At the end of the day, this is why you should always diversify, try and buy under the FDIC limits, stick with money market funds with large institutions that you trust, or look into government-backed treasuries or bonds that won't be at the mercy of the banks, or invest your funds into things like property or commodities such as gold or buy-to-let, although interest rates have gone up a lot, so you need to consider that. There's the possibility that there could be much worse issues than we're currently being made aware of. That may explain why Janet Yellen had an emergency meeting last week Friday. With all that said, let me know in the comment section below if you think this is a big deal or something to worry about, or if it's nothing and the headlines are getting ahead of themselves. So thanks again for watching. I hope you found this useful. Don't forget to share, like, subscribe, hit the subscribe button, comment in the section below. Obviously that can help the algorithm. And again, we'll keep you up to date. Take care. All the best.